The credit bubble is beginning to burst. A devastating report was recently released about credit card debt in the United States. We're gonna take a look at not only how much debt Americans have, but also the delinquency rates and also what interest rates are doing, and finally, how that fits into the broader credit situation overall and what's going to happen to the economy as a result. First of all, today, the US average credit card debt is almost $6,000, with millennials having the highest per demographic. The average monthly payment for credit card debt right now is $1,500, while millennials are at a staggering $2,400. Now, a couple of years ago, I told everybody, get a fixed rate mortgage because eventually your credit card debt will be larger than your mortgage. People called me crazy, but $2,400 is larger than most people's rent and mortgage today. If we take a look further into the pain that this credit card debt is causing Americans, we can see that 36% of people say that they have missed a credit card payment because they had to pay for food or groceries. And while almost half of Americans think that they'll be able to get out of debt within a year, it's important to note that 28% of people think that they won't be able to get out of debt for 5 years, and that 11% don't see themselves getting out of credit card debt within the next 10 years. The survey also found that almost half of Americans use their credit cards to cover basic living expenses. And the worst statistic they found overall, in my opinion, is about maxed out credit card balances, because over half of Americans have reached their credit card limit at some point, and almost 1/3, 29%, admit that they max out their credit card every month. So theoretically, if you've got $20,000 available to you on your credit card, that means every month you hit that $20,000 maxed out credit limit, you pay off some of it, let's say 3 or 4 grand, and you load it right back up the next month. This is a sign of people who have used their credit cards as their emergency savings account to make ends meet and no longer have any room left on that road. And remember, that's 29% of Americans. As a result, things are changing. This is kind of like the old cliche that high prices are the cure for high prices. Well, kind of the same thing going on here. Once you reach the end of that credit road, you start to see things unwind pretty quick, which is why some analysts are expecting interest rates to go even higher in 2024, which is terrible considering rates are already at multi-decade highs of over 21%. For years, they stayed around 15%, and before that, they were steady around 12%. This is one of the reasons why I teach members of Heresy Financial University to get rid of their variable interest rate debt first above everything. And credit card debt is the worst offender of all variable rate debt because there's no collateral, so they charge a crazy high interest rate, and it's variable, so when rates go up for everything else, credit card rates go up way faster. And these high rates have recently started to gain attention from lawmakers who are now looking at limiting interest rates on credit cards as a result of this crazy high credit card usage. Now, if we were to just stop here, we would not be able to see that this looks like the credit bubble is starting to burst, that it's starting to pop. But when we peel back the layers, look at what's going on underneath, we can see that it does indeed look like things are slowing down quickly. Number one, we take a look at the tightening standards for credit card loans. We can see that banks are recently rapidly increasing their tightening standards. The last time it was this high was in 2020, and before that was the Great Financial Crisis, which makes complete sense because when interest rates go up, that means for every dollar a credit card company loans out, they're making a higher amount of profit, of revenue, so they don't have to loan out as many dollars. So why not only loan out those dollars to the more creditworthy borrowers? And as further evidence that this is not just isolated to what's going on with credit cards, but it is evidence of a broader credit slowdown, we can see the exact same tightening standards happening with commercial and industrial loans to large and middle market firms. Again, the last time lending standards were this tight were in 2020 and the Great Financial Crisis. And before that, the dot-com bubble burst. Now, it's certainly true that a rising interest rate environment means they get to be more selective with who they loan money to, so those are tightening standards. But it's also true that delinquency rates have pushed this a little bit as well. We are seeing delinquency rates for credit cards increase recently. Now, if we take a look at all credit card loans, we see this big quick increase recently in delinquency rates. The last time they were at this level was all the way back in 2012. But that includes the big banks. So if we remove the 100 largest banks and we look at all of these small lenders, the picture looks a lot worse. This is what the delinquency rates look like for credit card loans to banks that are not among the 100 largest in size by assets. And we can see, as far as this data has been collected, delinquency rates have never been this high. Essentially, what's going on here is that people have maxed out multiple credit cards. They don't want to damage their relationship with the big major banks, so they have a couple little credit cards that are off on the side to other lenders, and they're letting those go first. So we have crazy high credit card utilization, we have delinquency rates going up, we have interest rates going up, people using credit cards to cover basic expenses, but all of that means that the existing credit card debt you have becomes more expensive, which is why we are also seeing right now that spending on credit cards is actually starting to fall very quickly. Over the last couple of months, we've seen a steep drop off in the amount that people are using their credit cards. Now, this makes perfect sense given everything we've looked at. People have maxed out their credit cards. They're starting to let some of their credit card loans default. They're missing payments or late on payments. And the existing debt that they have is getting so expensive that they cannot afford to stack it up any higher. Their credit lines are being decreased, and as they pay, they're using their cards less and less just to maintain the same payment. So you would actually expect to see something like this happen, a drop off in spending on credit cards. Now, this is ultimately all just one symptom of a larger problem. Yes, this is a very big and painful symptom, but when you print more money than you ever have before, like we did in 2020 and 2021, that money causes an asset bubble, and then it causes inflation in goods and services. You suck people into thinking they're rich by inflating the price of their assets. People start going on a spending binge. Then you have prices of goods and services start to skyrocket as the cost of living rises. And then people load up on credit card debt just to make ends meet, thinking it's a short-term temporary blip, and ultimately wind up in massive amounts of sometimes inescapable debt. And to pour salt in the wound, in order to stop the inflation, central planners ratchet up interest rates. Now, it's true that if you keep that easy monetary policy for too long, you do wind up with hyperinflation. But it's also true that the cure for that they're raising interest rates, is also extremely painful for people. That the average person gets the short end of both sticks. And that rising interest rate environment, while it's hurting the average person, it is also making very big opportunities available, basically to loan money to the government. And so anybody with excess savings, which is by and large not the bottom percentage in terms of income and wealth of the population, anybody with that excess savings, they're able to find opportunities to start to see decent returns considered risk-free by loaning their money to the government. This is why we're seeing deposit flight at commercial banks right now. Starting in April of 2022, we started to see deposits at commercial banks decline. Over that same time frame, starting in April of 2022, we started to see purchases and inflows into money market funds skyrocket. Money market funds, by and large, are the ones that are taking advantage of the short-term rise in interest rates, which commercial bank deposits are as of yet not seeing. So people are taking money out of their bank accounts and putting it into money market funds, which as a result is being lent to the United States government. So the government gets the money they want to borrow. The people with excess savings get the profit on that from the higher yields, and it crowds out investment for everything else. Number one, banks have less money to lend out. So we talked about tightening standards earlier and how one of the reasons for those tightening standards was because of interest rates being higher. They can be more selective with who they want to lend money to. A second reason for those tightening standards is because of delinquency rates. In a time like this, you don't want to be lending to the over-leveraged that will probably not be able to pay you back. But also, we are seeing a deposit flight from banks right now, which means they just have less money to lend out, period, which is also contributing to tightening lending standards. This means that there is less money available for all other economic actors, especially the businesses that are actually producing the wealth in this country. While the government becomes a larger and larger tumor, siphoning away resources from a healthy body and incentivizing the body to send that tumor more of its resources, we have less and less available for the productive sector of the economy. And unless something absolutely insane happens, this trend will continue. We are likely to see over the next 5, 10, 20 years, higher inflation rates, higher interest rates, for everybody except for the government. They'll continue to get every dollar they ask for, and the moment that it looks like they won't be able to afford it, the printer will come in and save them. But that next bailout will be just for them, not for the rest of us. And if you're wondering how to play this and how to profit off of this long-term, manage your downside risk so that you don't get stuck in a losing trade for years from inflation or deflation, market crash, interest rates changing, managing those kind of risks and being able to profit in all market environments is exactly what I teach members of Heresy Financial University. And for 99 bucks, which is less than the cost of a coffee at Starbucks every single day, you can't afford not to join. Link is below. As always, thanks so much for watching. Have a great day.